last month, you thought things got overheated in tech world, FANG world, NASDAQ world, and you went from overweight down to an neutral, to an average weight, and locked in some profits, and you made a switch, and you think the switch is working, and you're sticking with it. What did you switch to?
So the market had had a tremendous run that, in our view, was largely driven by the technology stocks, Joe, and we looked at those stocks collectively, and they're all trading at about, 50, 60 times earnings. Yet a lot of these other sectors, domestic large cap value, small cap stocks, international stocks were trading back in the teens, and there was a significant gap in performance. So we really thought that the overall market had probably gone a little too far, too fast from that March 23rd bottom, largely driven by the tech stocks, the FANGs, et cetera. And so we felt that taking some profits in that area and sort of dialing that back to neutral and re-emphasizing these other areas that were cheaper would sort of spread the risk out a little bit better. And we felt that the catalyst in terms of getting those underperformers going is that economic growth and corporate earnings growth in the third quarter is going to be a lot better than the second quarter. So once investors got a sense of that, we felt that we would be able to play a little bit of catch up with those laggards.
The backdrop for this, if you want to go into it, because it's kind of interesting what you're saying. So it's the deepest recession that we've seen in a long time, and probably the quickest rebound in both, maybe in the economy and in the stock market, and that is totally justifies the move we've seen in stocks. Phil, go into what you're expecting, and I know you have a feeling about third quarter GDP. I was referencing that earlier. Sure. As well as the type of corporate results we'll see in the third quarter.
So there's been a lot of hand-wringing about, this 63% rally we've seen in stocks and whether or not it's justified. And the reality is that the equity market historically has been a forward-looking discounting mechanism of what's going to happen 6 to 9 months into the future. And there's no question that we suffered a waterfall decline of historic proportions, back in March and April from an economic standpoint, but we've had a tremendous rebound, literally across the board, housing, autos, consumer spending, manufacturing. And so as we look out to what those numbers look like, into the first part of next year, and then as investors sort of price that back into where we are now, there was justification that the market rallied. But we thought the S&P 500 would get to the 3,500 level by the end of the year. We got to almost 3,600, in the beginning of September. So in our view, the market had just run a little too far, a little too fast. So taking some profits, particularly locking in some of the technology profits, in our view was just sort of a risk management decision that at least up until now appears to have worked.